In this video, I'm going to show you the only smart money concept you really need in order to spot manipulation maneuvers in the market and make great trades with it. As many of you know, I have created a free smart money concepts course based on the Wyckoff methodology. And if you watch the course, you'll notice that there are a lot of rules about what the market should do in each market phase. The problem with that is that trying to box the market into predefined patterns is like trying to impose someone's idea on what the market should do. The same exact problem happens with the Elliott Wave theory. There are all these specific rules about what the market should do. The reality is that the market does whatever it wants to do. The correct approach is having a methodology that reacts to the market in any situation, instead of imposing what the market should do. In the case of Wyckoff, if you try to spot the slow reversal pattern in the way the methodology proposes, you will spend most of your time trying to find this pattern while you miss the great trade opportunities happening in front of you. With that in mind, I decided to make this video talking about the only smart money concept based on Wyckoff that you really need. And the best thing about it is that it's very easy to see and usually yields a very powerful trade opportunity. Wyckoff used to talk a lot about how to spot the manipulative maneuvers by observing supply and demand and volume. But in this case, you can spot these patterns just by observing candlesticks. In the Wyckoff method, there's a lot of talk about the spring in the case of an accumulation, or the upthrust after distribution in the distribution, which are the most important maneuvers that traders following this method aim to catch. The problem is that the Wyckoff method makes a lot of restrictions about what needs to happen before these key maneuvers. Manipulative maneuvers are simpler than that. They happen without the necessary appearance of preliminary stops, climaxes, tests, and secondary tests. The pattern goes like this. Whenever you see a high or low in the chart, you can be certain that there are a lot of retail traders that place orders in those levels. In the case of a high, for example, there are many retail traders that will place buy-stop orders at the high or stop-loss orders at the high. In the case of a low, there will be a lot of sell-stop or stop-loss orders in there. A buy-stop order in a high is simply a buy order. A stop-loss just above a high is the stop-loss of a short trade. The stop-loss of a short trade is a buy order as well. A sell-stop order in a low is simply a sell order or supply. A stop-loss order just below a low is the stop-loss order of a long trade. The stop-loss order of a long trade is a sell order. In summary, there is a lot of buy orders or a lot of demand at highs and a lot of sell orders or supply at lows. One of the important points here is that since everybody can see highs and lows in the chart, the place where these orders are sitting is obvious. The smart money, meaning the large traders and institutions, know this, of course, and they will use these levels to their advantage. Whenever there is a cluster of buy or sell orders, the smart money sees an opportunity to enter the market. That's the case because in these clusters of orders, there is the opportunity to enter massive orders in a short price range. These clusters of orders are often called liquidity pools. The smart money intentionally triggers the orders in these liquidity pools by making price reach these levels. They can do that since they have the power to move the market in certain situations. When price hits those levels, the retail traders' orders are triggered. For example, if a lot of buy orders are triggered at a high, it means that there is the opportunity for someone to be on the counterpart of that. That's where the smart money enters the market selling aggressively. The same happens in the case of a low, of course. When a lot of sell orders are triggered at a low, there is the opportunity for someone to be on the counterpart of that. That's where the smart money enters the market buying aggressively. The point here is that you can see when the smart money is intentionally triggering these orders and then entering on the opposite side of the market. And all you need to do is to observe the candlesticks themselves. Let's take the example of a high first. The smart money will intentionally nudge the market slightly above a specific high, which can be any high in a chart. That will trigger many buy-stop orders of retail traders who think that if the market surpasses that high, an uptrend will follow. And it also triggers the stop-loss orders of retail traders who were using that high as a protective stop. The key here is to understand that once that high is triggered, there is a lot of demand in a very narrow price range. At this point, the smart money must be powerful enough to absorb all this demand by selling aggressively. When they absorb all the demand by selling aggressively, they make that candlestick close below the high in question. The maneuver here is half complete. The smart money is already positioned in the right side of the market, and the retail traders are frustrated and ready to attempt to recover their losses. So they will start to sell now, which is exactly what the smart money wants them to do in order to drive their massive short positions in the right direction. You can spot all of that by observing a prominent upper shadow in a candlestick that pierces a previous high. You don't need anything else. No need for the identification of preliminary stops, climaxes, tests, and secondary tests. By the way, this manipulation pattern occurs in all markets and all time frames. Notice also that it seems like nothing important is happening here. That's one of the reasons why the smart money looks for deep liquidity pools. They want to enter the market aggressively without grabbing too much attention. Even though the candlestick ranges can be narrow, the number of orders can be large. In this current candle, it's clear that the upper shadow implies the aggressive entrance of supply after price surpassed the major high highlighted by the black line. In this next image, we can see that price starts to go down after the alleged manipulation, and at the current candle, something interesting happens. Another prominent upper shadow that touches the major high level. This market still had some momentum to the upside, and retail traders attempt to go higher. When the price reaches the liquidity pool level, the aggressive selling starts again. Eventually, all the retail demand is absorbed, and a downtrend begins, as you can see in this chart. No need to identify preliminary stops, climaxes, tests, or secondary tests, or anything like that. Just look at the prominent candle shadows piercing important market extremes. The same process occurs in a low, of course. Let's observe an example of that. In this chart, we see price piercing a previous low, which seems to be important in relative terms. The important thing here is noticing that the candlestick that pierces the low has a prominent lower shadow. That's the smart money signature. That's how you can tell they nudged the market to the downside in order to induce retail traders to go short, just so they could absorb that supply and enter long positions. Notice that in this case, the market goes back to the low in question 2 more times. Even though the smart money traders have the power to nudge the market and absorb a lot of supply, sometimes they must do the same process a few times. However, sometimes price just reverses without coming back at all. Notice also that the prominent lower shadow naturally creates a stop loss level for the traders who are aware of the smart money manipulation. It really is that simple. Once you see a prominent candle shadow piercing a significant market extreme and failing to close with confirmation of the breakout, you can start thinking about trading with the smart money. One of the signs you can look for in terms of confirmation beyond the prominent candle shadow is that right after the manipulation, the market will display some sort of pattern like an inside candle or a dynamic frequency breakout, for example. For the follower of my methods, sometimes you can spot a fractal candle in there, which often happens at reversals. If you are patient enough to wait for this sort of pattern to appear, and then take advantage of it, you will be ahead of 99% of retail traders out there who are still worried about which moving average period they should use. After testing the level where the manipulation maneuver happened 2 times, price takes off and forms a nice uptrend, as you can see in this chart. That's it for this video. If you like the material I produce, please click the like button, subscribe to the channel, activate the notifications button, share the video, and leave your feedback below in the comment section. If you wish to learn how to trade using professional tools, check my website fractalflowpro.com or send me an email at support@fractalflowpro.com. Thank you very much for watching, and I hope to see you in the next videos. Take care.